Hello, I'm John Ward on behalf of Physical Gold Fund and Anglo Far East, and we're delighted as always to have with us here Jim Rickards. Mr. Rickards is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for Physical Gold Fund. Jim is the author of the New York Times bestseller Currency Wars, The Making of the Next Global Crisis, and most recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System. Welcome, Jim, and thank you for joining us.
Thank you, John. Great to be with you.
Jim, today I'd like to continue discussing some of the revelations and insights you share in your new book. In particular, I'd like us to explore aspects of the international monetary system. But first, let's do a catch-up on the current scene. In our recent interviews, we've been talking about forces that should lead to a rise in the price of gold. Right now, we're seeing quite some slippage in the price. What's your take on this?
Well, you're absolutely right, John. As you know, and I think as listeners know, I have a kind of intermediate, meaning say 3 to 5 year forecast for gold going up sharply, ultimately making its way to the $7,000 to $9,000 per ounce range, and that's the analysis behind that is fairly straightforward. That's the ratio of paper money to physical gold in the world. We have a good idea how much gold there is. We know how much money central banks are printing, although it is a moving target. You have to update the calculation every now and then for all the new printing. But basically, if money is worth anything, it has to be has some tangible value. Now, for some period of time, that disconnect has prevailed, but that tends to break down. And when it breaks down, some kind of relationship will be reestablished. I'm not saying there'll be a strict one-for-one gold standard, but at some point, a reference back to gold will be necessary to restore confidence. Now, we're not there yet. We may even be several years away, but that's where I see it going. However, it can be quite a tortuous path in the meantime. And I've said all along a number of things. First of all, gold is extremely volatile, so I never recommend using leverage. When you use borrowed money or margin, or you go into the futures market or the options market, you're a leveraged player and you're going to amplify your volatility. In my view, gold is volatile enough as it is, doesn't need any extra volatility on top of that. Number two, I've consistently recommended a modest allocation, 10%. For most investors, 20% of your investable assets, if you want to lean into it a little bit, be a little more aggressive. But I think for the typical everyday investor, I recommend a 10% allocation to gold. And that's precisely because of the kind of volatility we see. In other words, if you go in 10% and gold goes down 5%, you've only lost 0.5% on your portfolio, so hardly a wipeout. But if it goes up 2 or 3 or 4 times, which I expect, then you'll do quite well on that 10% allocation. So because of the asymmetry in the potential upside versus the potential downside, that's why I recommend the 10% allocation. So with those two things said, one, gold is extremely volatile. Two, don't use leverage. And I guess the third point is keep it to about 10%. You can weather this storm, but as for the specific reasons, in recent days, gold has drawn down sharply. It's down about 5%. There are a couple of reasons for that. One, we can never know the times and the places, but we can be certain that the gold market is manipulated. The debate on whether or not gold is manipulated by countries and by central banks and finance ministries in particular is closed. The evidence is clear. There's statistical evidence, anecdotal evidence, forensic evidence. It's a very long-standing. Go back to the 1960s gold pool, the 1970s dumping of gold by the United States, 1,000 tons, and the IMF, about 1,400 tons in the late 70s, and there's correspondence on that was classified at the time, which has since been declassified, that I've been able to dig out and put in my book, The Death of Money, including, and then some more recent evidence, including some studies I've seen. So the manipulation is there. Now, that doesn't mean that on any given day, if the market goes down, you can point a finger and say, aha, it's being manipulated. Maybe it is. That's entirely possible, but there could be other things at work. But that's one of the things that's out there. But there are also technical factors having to do with the fact that hedge funds are now large players in the gold market. Historically, that was not the case. Gold was it was almost a kind of a barbell. At one hand, you had the small holder who always felt more comfortable with some gold coins or bars in their possession, and then the largest holders, sovereign wealth funds and central banks, and in between, you didn't really see institutions involved very much one way or the other. Today, that's not true. A lot of big hedge funds are in gold. It's important for gold investors to understand how hedge funds operate. To them, maybe gold's an interesting market, but they have certain ways of trading. It doesn't matter if it's, coffee beans or soybeans or treasury bonds or anything else. They have what are called stop loss limits. In other words, when they put a position on, they say, if I lose a certain amount, I'm going to get out of it. Maybe I'll get back in later, but I don't want to sit there and just sort of bleed all over the floor. So they have these stop losses. So what happens is, now combine the two things. Combine the manipulation on the one hand with these stop losses that the hedge funds use on the other. So now it makes the manipulation job even easier, because all you have to do is throw in a large sell order, push it down a certain amount, and then once it hits that amount, you begin to trigger these stops. So it's exactly the way a power grid collapses. You hit one circuit breaker, and then it goes off and redirects the power. There's a surge, another one hits, it redirects the power, there's another surge, and the next thing you know, the whole power grid's going black. Same thing happens in gold. Once one hedge fund, once you hit a stop loss price, that hedge fund automatically sells. Guess what? That drives the price down more. The next guy hits his stop loss, he sells, drives the price down more, et cetera. And this gathers momentum, and next thing you know, everyone's selling. Maybe no one who woke up that day wanted to sell, but they all end up selling because of this cascading effect. So the combination of a little bit of momentum to get the ball rolling, and a lot of leverage players and hedge funds who had these stop loss limits built into their systems, getting triggered one by one, can take it down very quickly. Now, none of this, by the way, has anything to do with the intrinsic value, the long-term value, or what I call the strong hands. The strong hands are people who buy the gold, they don't use leverage, they have physical, they want to hold it for a long time. They're sitting there. It's never fun when you own an asset, whatever it may be, and you're watching it go down. No one enjoys that. But it goes back up again. And so I think the strong hands just understand that they have to weather the storm. The leverage players are going to get whipped around in the way I've described. And it's a combination of some manipulation and a lot of these technical factors that are driving it down. But as we've discussed in past interviews, available on the archives, the physical technical side of it is extremely bullish, but the leveraged technical side of it can lead to these very sharp drawdowns every now and then. So I think investors just have to expect it, but remain confident that the long run path is upwards.
Very clear, very helpful. Thank you. Staying with the current scene for a moment, we love to have questions from Twitter followers and using the hashtag AskJimRickards. And we've got one here from Howard Wetzman. His handle is @AddictionDocMD. I guess he's a doctor. And he asks you about the Russo-China pipeline deal, and the reports that this deal is going to be transacted in dollars. He wants to know why and what are the consequences.
Well, I think the deal has been very well publicized and well vetted. It's probably the largest bilateral energy deal ever concluded. It runs for 30 years, and it's not just energy in terms of providing the oil or natural gas. It's also a massive multi-billion-dollar, multi-decade infrastructure deal, because you've got to build the pipelines and the other facilities to actually move the oil and natural gas from Central Asia, from Russia into China. So it's a massive deal, hugely significant, ties them together. It does a lot of things geopolitically. It strengthens China's hand, because they can conduct the deal with Russia in any currency the two parties agree, and makes China less dependent on the Middle East, although they'll certainly still be buying a lot of oil from the Middle East. And it strengthens Russia's hand, because obviously they have a very large market in Europe, but to the extent that Europe wants to rally around NATO and try to separate the Ukraine from what Putin views as the Russian sphere of influence, etc., they'll be even more dependent on Russian natural gas. If Russia can turn the pipeline off, it's hard for Russia to do if they don't have any place else to sell it. But once they start selling to the Chinese, it's easier to leave the Europeans in the dark. So from a geopolitical point of view, it cannot be more significant, and it's negative for the dollar in the sense that whenever two major powers who are somewhat locked into the petrodollar deal find a way to do business on their own without dollars, obviously that pulls one of the legs out from under the stool of the dollar. Now, as to the specific question, will the deal be priced in dollars? at least in part, at least for the short run. Look, none of us have seen the contract. The contracts are written in Russian and Chinese, and they're secret documents. So I'm not going to sit here and claim that I've read it line by line. I haven't. But in a way, it makes sense, at least in the short run, to price it in dollars. And here's why: because China's paying. Russia's pumping the oil and natural gas. China's paying Russia. If you're China, you want to dump all the dollars you can. And so it's sort of like a game of hot potato. The Chinese are saying, hey, Russia, here's the dollars for the energy. You figure out what to do with them because we don't want them anymore. And so throw them over to Putin and let Putin figure it out. So, look, we don't know all the currencies this deal may be priced in the long run. It may end up being priced in euros. It may be priced in gold, for that matter. Maybe at some point Russia turns to China and says, hey, if you want this oil, pay us in gold. 30 years is a long time. I think 30 days is a long time in geopolitics these days. So I don't think any of us know what the deal will be priced in. I'm certain that there's flexibility in the contract to price it in various mediums of exchange the parties might agree on. And any contract can be amended if the parties agree. So even if you start out one currency, a few years from now it could be a different currency if the Russians and Chinese decide that's what they want to do. So in a way, it's always a gun pointed at the head of the dollar because the two parties can do whatever they want. What matters is that the contract is in place. But if, in fact, some of these reports are true, that it will be priced in dollars, at least in the short run, that really is not that surprising because if I were China, I would want to dump my dollars too.
Well, thanks for the answer, and thank you, Howard, for a very interesting question. So now let's turn to the big picture for a moment in your book. And there's a chapter in The Death of Money about the IMF, which may not seem the most exciting topic, but actually what you disclosed to my mind is quite jaw-dropping. It turns out that the IMF has a really pivotal role in the global monetary system with far more power and influence than might first appear. We're normally led to think of the IMF as a sort of benign friend of small emerging countries, and your picture is very different.
Well, calling the IMF the benign friend of small emerging countries, it reminds me of one of these very large, rapacious corporations that every now and then makes a donation to charity just to show what good guys they are. The fact is the IMF has always been a rich countries club. The IMF has a voting system. The IMF is funny. It's almost as if we have plain English on the one hand, and they come along and invent a new word to mean the plain English, so no one understands quite what they're talking about. But they use the word quota, where we would talk about shares or votes. So let's say I owned 5% of a corporation, and I would say I'm a 5% shareholder. Well, they say you have a quota. So think of that as the equity in the IMF. And the quotas are very heavily weighted to the richest countries. So whenever anything has to be voted on or approved, they're the ones who collectively have the votes. They have a very interesting voting mechanism. They require an 85% vote to make any significant changes. So if you want to change the articles, which is the governing document, or you want to approve a major lending initiative, it requires an 85% vote. Well, guess what? The United States has 16% of the votes, which means that if all the other members combined voted against the United States, it still wouldn't be enough to make anything happen because the 16% vote is a veto, because if you throw 16 in the no column, the most you can muster in the yes column is 84, which isn't quite 85. None of this is by coincidence, of course. So the U.S. has de facto veto power. One of the big governance issues in the world right now is actually shifting the votes. If you thought about it in terms of how much your GDP is a percentage of world GDP, compare that to your IMF vote, the rich countries are overweighted and the emerging markets are underweighted. China is a good example. China is about 10% of global GDP, but its vote in the IMF is nowhere near 10%. It's much closer to 5%. Now, there is a movement underway inside the IMF to shift the votes around, but of course it's a zero-sum game. All the votes together have to add up to 100%, which means if China's going to get a few more, somebody else gets a few less, and somebody else are countries with names like Belgium, Netherlands, and other countries in Europe. Of course, they're resisting this. So there's a big kind of shadow political struggle going on behind the scenes. But John, coming back to your first point, about the power of the IMF. The IMF is like a can of Play-Doh. I don't know if listeners ever used Play-Doh when they were kids, but it's something you can shape into any shape that you like, mold it and shape it and do different things with it. And the IMF started out after 1944. It was created at the Bretton Woods Conference in 1944. It took a couple of years to get up and running in the late 40s, but it really started as a swing lender for wealthy countries experiencing short-term balance of payments deficits. So you had a fixed exchange rates under Bretton Woods. So let's say I was running a deficit year after year. Well, one of the ways to fix the deficit is to cheapen my currency, make my exports more competitive. But cheapening your currency wasn't allowed under Bretton Woods. What happened was that they would give you a loan to tide you over, and then you would make structural reforms rather than monetary reforms. So you would maybe lower unit labor costs or improve productivity or shift assets, do whatever you had to do to get your current account back towards a surplus. So they were swing lenders so that you could tide people over. Now, that all broke down, of course, in the late 60s, early 70s. We went off fixed exchange rates. Ever since then, we've had floating exchange rates, which a lot of people advocate, like Paul Krugman. But the reason they advocate it is because, you can cheapen your currency whenever you want. But, of course, that just leads to inflation. But people like Krugman don't mind inflation. They don't even mind lots of inflation. But then so the IMF kind of wandered in the wilderness. Probably in the 80s, early 90s, they were a little more of a lender to emerging markets. That was because their original mission of stabilizing exchange rates under Bretton Woods was gone. So by the 80s, they became a more of an emerging markets lender. But, of course, that ball blew up in 1997, 1998. A lot of people to this day, I think most famously Joe Stiglitz, attribute, there were actual, you go back to 1997 with the Asian financial crisis, there was blood in the streets, not metaphorical blood, but real blood in Jakarta, Seoul, Korea. People were killed in riots, etc. And a lot of that was blamed on really bad advice from the IMF. So by 2000, let's say, they were kind of like this big whale that had, washed up on the shore and couldn't get back to its mission. So the swing lending mission was abandoned in the 70s. The emerging markets doctorate mission, if you will, was abandoned by 2000 because they were terrible at that. And then early 2000s, they were sort of like an agency without a mission. No one quite knew what they were doing and what they should be doing. And by 2006 or so, there were actual calls. Well, gee, why don't we abolish the IMF? Who needs it, right? But then a funny thing happened on the way to abolishing it. We had the global financial crisis of 2008, and all of a sudden the IMF was back in the game. It became the de facto secretariat of the G20. I think of the G20 as a board of directors and the IMF as an agency that implements the will of the board of directors. Now, the IMF has their own board of directors, but interestingly, if you look at that membership, there's a lot of overlap. The G20 countries and the 24 members of the IMF Executive Committee are by and large the same. And so the G20 was a group of heads of state. They didn't have a staff, while the IMF was sort of a ready-made staff. So ever since then, the G20 summits and the IMF technical abilities and staff and analysts and, most importantly, lending facilities have worked hand in glove to deal with the global financial crisis. But back to your original question, the vast majority of that lending has been to bail out Europe. This money is not going to places like Botswana or Mali or Jamaica. It's going to places like Poland and Greece and Portugal and Ireland and the countries that we've all heard about. So the IMF is kind of back to its original mission of lending to rich countries, which the overwhelming majority of its money is directed to. And as I say, it's found a new lease on life. But it also, in addition to lending money, well, if you're going to lend money, where do you get the money to lend? Well, banks take deposits. The IMF doesn't have a teller window where you can make a deposit, but it does borrow money. It issues notes. Interestingly, these notes are not denominated in dollars. They're denominated in SDRs, or special drawing rights. So all of a sudden, the IMF is one other feature which makes it really identical to not just a bank, but a central bank, which is the ability to issue money. Of course, the Federal Reserve is a printing press. They print dollars. The European Central Bank is a printing press. They print euros. Well, the IMF is a printing press also. They can print these special drawing rights, or SDRs. So when you look at the IMF, they have a leveraged balance sheet. They have assets, they have liabilities, and they can print money. Well, that's a central bank in all but name. Interestingly, the Central Bank of the United States is not called the Central Bank of the United States. It's called the Federal Reserve. That name was chosen on purpose to confuse people about what it was, because when it was created in 1913, the United States, the people of the United States had a long history at that point of hating central banks. We had two central banks in the past, and both of them had been abolished. And here was a third central bank, but they called it something else to confuse people. The IMF is very similar. It's not called the central bank of the world, but it is the central bank of the world for the reasons I just described. And the SDR, the special drawing right, is not called world money, but it is world money. So if you started using names like, oh, the central bank of the world just issued some world money, that would sound pretty scary to people. But if I say the IMF just issued some SDRs, no one knows what the heck I'm talking about. So this is an example of how the power elites use anodyne names to hide and confuse people about what's actually going on. But again, this is not black helicopter conspiracy stuff. It's actually out there on their website. I like to say the IMF is transparently non-transparent. That is to say, they tell you what they're doing, but they use a language that pretty much only people who work at the IMF understand, so no one really gets it. But by the way, they did issue some SDRs in 2009. I think I was the only one who doesn't work at the IMF who noticed that. But it was over $100 billion equivalent of new world printed money that was handed out at the time. And they're standing by. They don't issue SDRs except in a liquidity crisis. They're not out there printing them, day and night, the way the Fed is printing dollars. They kind of stand by. But the next time there's a global liquidity crisis, which we can certainly expect in the next year or two, because they do happen with great frequency, it'll be bigger than the Fed. The Fed has used up its balance sheet, used up its dry powder, if you will, dealing with the last one. They have not been able to unwind the balance sheet. I think it's unlikely they will. The same is true of the other central banks. So they've got no more capacity to print money, at least without destroying confidence. They might have the legal capacity, but I think they're at the outer limit of what they can do without destroying confidence. But we can count on the IMF to print this world money. So in every respect, taking in deposits in the form of borrowings, lending out loans in the form of assets, having capital and printing money, having this global sort of board of directors in the form of the G20 heads of state and finance ministers. In every respect, it walks, talks, and acts like a central bank of the world. So I call it the central bank of the world.
So let's just talk about SDRs for a moment, because it is a bit of a mystery. The name is confusing. And you and I can't go to an ATM and withdraw a fistful of SDRs. And yet, SDRs, as I understand your definition of money, fulfill that definition. And it seems that they may play an increasingly important role as the dollar likely declines in its power in the world. So could you explain a little bit more about what an SDR really is and what role it's playing and likely to play in the world?
Sure. There are sort of three parts of a classic definition of money. When you say what is money, I mean, you can debate that all day long, but typically people say it's a medium of exchange, it's a store of value, and it's a unit of account. And if you have all three of those criteria, then you are arguably money. Well, let's just look at the SDR with that scorecard. We'll start with the last one I mentioned, the unit of account. Well, it is a unit of account. The IMF keeps their books in SDRs. If you go to the IMF website and click and find the financial statements of the IMF, it's in SDRs. If you say, when they borrow money and they give you a note, what is the note denominated in? It's denominated in SDRs. When the U.S. Treasury has a standby commitment, it's already in place. It was slipped into some legislation in 2009 by Barney Frank. But the U.S. has given the IMF a $100 billion line of credit. It's like walking around with a credit card that you haven't used where the line of credit is good. The IMF can, at almost any time, put in a borrowing notice and get that $100 billion from the United States. Well, I say dollars, but in fact, it's a dollar equivalent. If the IMF wanted the money, they would hand the U.S. Treasury a note denominated in SDRs. We would no longer have a dollar asset on the books of the Treasury. We would have an SDR asset. So it is a unit of account. As far as the store of value is concerned, these are counted in the official reserve positions of countries around the world. Go to the website of the Central Bank of Russia, the People's Bank of China, or the United States for that matter. You'll find a certain amount of SDRs, and those are counted as money, good, or value, if you will, by those various countries. And the last one is a medium of exchange. again, you can pay for things in SDRs. Now, individuals cannot. You're right. You and I can't get them at the ATM. I can't use them to pay for dinner or take a taxi cab. But countries can use them between each other. And that's, I think, the part that makes it a little more difficult to understand. In settling a balance of payments between two countries, SDRs can be used. There's actually a trading desk inside the IMF. They have an SDR swap desk, and I'll give you a very simple example of how that works. So I mentioned in 2009, the IMF issued a bunch of SDRs. Well, the way they issue them is in accordance with the quota. So again, quota is your share. So if I have a 5% quota at the IMF, and the IMF is issuing 100 billion SDRs, then I'm going to get 5 billion SDRs because that's my 5%. Well, a lot of countries got quotas and they didn't need the SDRs. I'll take Hungary as an example. The Hungarian banks and Hungarian customers, going back to the early 2000s, were offered mortgages in two currencies. They could take it in their local currency, which is the florin, or they could take them in Swiss francs because the European banks were very active in Hungary. Well, the Swiss franc mortgages were 2%. The florin mortgages were about 9%. So most of the borrowers took the Swiss franc mortgages at 2%, assuming the exchange rate would be fixed, but it wasn't. The florin collapsed, and all of a sudden the mortgage debt increased dramatically because the exchange rate changed, and there were a lot of defaults there. So you're Hungary, so the IMF hands you some SDRs, but you're saying, well, I don't need SDRs. I need Swiss francs because I got to pay these Swiss and Austrian intermediary banks back. Well, you could call the desk at the IMF and say, bid me SDRs, and the IMF will call up a place like China and say, do you have a bid for SDRs? And China will say, yes, we do. And China will send dollars, get SDRs in return. Hungary will get the dollars, sell them spot, buy Swiss francs, and pay back the Swiss bank. So that's a way to turn your SDRs into something else if you need them. So that's the medium of exchange. So in all three counts, unit of account, store of value, medium of exchange, the SDR does qualify as money.
So if I get the picture from what you're telling us here and reading your book, that the IMF is printing money out of thin air and it's using leverage, not as massive leverage as other banks, but it's using leverage. And you describe the IMF as the ultimate lender of last resort. And when I hear the word last resort, I wonder what happens after the last resort. Are there any potential hazards in this structure?
Yes, there are, and they're the same hazards in the existing structure of central banks. And you make a very good point, John. So let's just take the Federal Reserve, the U.S. central bank, as an example. Why was it created? Well, it was created in 1913 to be a lender of last resort to the commercial banks. There had been a banking panic in 2007. That banking panic had to do with a commodities bet that one of the banks, the Knickerbocker Trust, had made that went bad, and that started a run on the bank. And then that bank had to be propped up, but other banks were threatened. So it was a typical run on the bank. Now, the way that was sort of brought in for a soft landing was J.P. Morgan, not the bank, but the man, the actual individual J.P. Morgan, called a meeting of all the major bankers of the day at his townhouse, his mansion in Manhattan, and down around 34th Street, and they sat around all night, and they just hammered out a deal, and they went out and did it. But then it was a scary incident. It was like a plane coming in for a crash, and at the last minute, someone grabs the joystick and pulls the plane out of a nosedive and gets it back in the air. That's what J.P. Morgan did. But people said, well, gee, wait a second. What happens when this happens the next time? What if J.P. Morgan's not around? What if there's no leadership? We need a big brother. So they created the Federal Reserve and the Federal Reserve printing press so they could, in effect, bail themselves out or save themselves from their own recklessness. And, of course, the Federal Reserve is not owned by the government. It's owned by the banks. So the bankers got the government to create a bank that they, the bankers, controlled to print money to save themselves from their own recklessness. Pretty sweet deal. The reason it took so long was from 1907 to 1913 was because if you're going to rip off the citizens, you have to do it through the back door, and that's what they did. It took a while to put that together. So now, let's look at the IMF. Well, what happens when the central banks themselves go bankrupt? What happens when the central banks themselves have been so reckless that they're the ones who are threatened? They're the ones where confidence is being lost. Who bails out the people who bail out the people, so to speak? Well, the answer is the IMF. The IMF is this central bank of the world. So in the short run, The reason the 2008 debt crisis was truncated, that was a private debt crisis by and large. It arose in mortgages and asset-backed securities and collateralized debt obligations, CDOs, so-called CDO squared, and all the other crazy derivatives that Wall Street cooked up to rip people off. So that was a private debt crisis that was bailed out by the central banks. But now that we've created all this sovereign debt and printed all this money, we're getting closer to an international sovereign debt central bank crisis where we actually lose confidence in the central banks. Who's going to bail them out? Well, the answer is the IMF. Now, the IMF will print the SDRs, hand them out. The countries will swap them among themselves. That'll reliquify the world. It'll be highly inflationary, by the way. But so that's why I call it the central bank of the world. Now, you've taken the analysis one step further, John, and said, well, hold on. What if people lose confidence in the IMF? Who bails them out? Well, the answer is right now there isn't anyone. If you think of, I don't think of it as kicking the can down the road. I think of it as kicking the can upstairs from private debt to sovereign debt to international or multilateral debt in the form of IMF. IMF is the penthouse. You can't kick it any higher. There is one thing standing behind it, though, which is gold. And by the way, the IMF is the third largest holder of gold in the world. Number one is the United States. Number two is Germany. Number three is the IMF. They have almost 3,000 tons of gold. So this is why I keep coming back to gold. This is why I continue to calculate the gold to money ratios and come up with the price projections I do because, people have said validly, well, gee, if we lose confidence in fiat money and dollars and euro forth, and you come along and try to bail it out with a different kind of fiat money, specifically the SDR, what good does that do you? Well, if it works at all, it'll only be because, for two reasons. One, nobody understands it. And two, as you said, we won't have them in our pockets. This will be used by countries, for countries, between countries, but not by individuals. So it won't be very transparent. They'll be out there. They'll be causing inflation. They'll be getting printed like crazy, but no one will actually see them. Because all this stuff is fairly technical. So if SDRs work, it's only because no one quite understands it. But assuming, people who listen to our podcast do understand it, and they lose confidence in that, then where do you go from there? And the answer is gold.
Well, that really does bring us back to the gold story, and I wanted to go there, but there's one little piece in the picture which I'm puzzled by. Maybe you could briefly explain, because I've always thought that the super bank in the world was the Bank of International Settlements, or BIS. Can you just briefly explain how that fits into the picture?
The BIS, Bank for International Settlements, based in Basel, Switzerland, has a very interesting, and I dare say checkered history. It was created not after World War II, the way the IMF was, but after World War I, really through some efforts in the late 1920s, early 1930s, led by the Bank of England. And I think of it as a treehouse, when a bunch of 10-year-old boys get together and build a treehouse. It's a place to hang out. Well, that's what the BIS is. Once a month, all the major central bankers in the world gather in Basel, Switzerland, and there are sort of tiers. There's a larger group of as many as 50 BIS members, but there's an inner group of 7 or so, might be a little more than that, maybe 10 now, but a relatively small number of central bankers. So the larger group gathers for certain meetings, but every now and then, let's say the 10 of them go off on their own, shut the doors and have their own little deals. This is the most non-transparent institution in the world. They don't put much on the website. They do a lot of technical research you can access, and they actually do have financial statements, but they don't tell you about their deliberations. There are no minutes released to what goes on behind closed doors. So this is a way for the central banks to manipulate the global financial markets with complete non-transparency. So if you ask me whether if I had a choice between the Fed minutes and the BIS minutes, I'd much rather have the BIS minutes, but I can't get those. You can only get them through, occasionally talking to people who've been there or anecdotally or through some history. Now, the BIS historically has been used as a major channel for manipulating the gold market and for conducting sales of gold between central banks, including commercial banks. And again, this history has been well vetted. There's an excellent book called The Tower of Basel. Not quite the Tower of Babel, but maybe a lot more significant in its own way. But I recommend that book, The Tower of Basel, if you want to drill down on the BIS. But one of the interesting things during World War II, while the fighting was actually going on, while during the D-Day invasion and so forth, the BIS was selling Nazi gold. Of course, the Nazis were desperate. They had a fair amount of gold, which they had accumulated in the 1930s. They needed to sell their gold to get currency so that they could pay for imports or pay for natural resources or other things that they needed. Well, guess how they sold the gold? They sold it through the BIS. The president of the BIS at the time was an American, Thomas McKittrick. So here you had this bizarre situation where Americans are fighting and dying, fighting the Nazis, but there's an American running an institution that's helping the Nazis sell the gold to get money to pay for armaments to kill the Americans. That shows you how sort of cold-blooded the gold market can be when it comes right down to it. Interesting historical episode. I'm not sure their ethics have changed very much in the meantime.
So back to gold then. It recurs as a theme in this whole story. We've talked a lot about possibilities and speculative, what may happen if things get to a certain extreme. But what is your overall sense of the place of gold in this story about the IMF, the SDRs, and the global monetary system?
Well, my main view, John, is that gold never went away. The popular narrative is, President Nixon closed the gold window August 15th, 1971, told our trading partners they can no longer get gold. The U.S. was delinked from gold. We've been off the gold standard ever since. And 2 generations of scholars have been rigorously brainwashed to believe that gold has no role in the international monetary system. But in fact, it never went away. If gold is so worthless, why does the U.S. keep 8,000 tons? Why does Germany keep approximately 3,000 tons? Why does the IMF have about 3,000 tons? Why is China acquiring thousands of tons through stealth? Why is Russia acquiring over 100 tons a year, although they've recently increased those purchases, and they now have well over 1,000 tons, even though their economy is only 1/8 the size of the United States? What's going on? Well, the answer is gold never went away. Now, it's highly convenient for central bankers to brainwash people into believing that money has nothing to do with gold because, of course, that lets them print all the money they want. But as I say, the gold never went away. It's still behind the system. And I explain this very carefully in my book, The Death of Money, particularly in Chapter 9 and Chapter 11. And a lot of the websites you read, they talk about gold as a percentage of reserves, and they say, China only has 1% of its reserves in gold. That's about the right number, maybe 1.5%. But I make the point that that's an irrelevant ratio. And the reason I say that is because it surprises a lot of people to learn that the United States of America has over 70% of its reserves in gold. And you tell people that, and they're like, wait a second. I thought we had a paper money system. Everyone from Ben Bernanke to Alan Greenspan and others have said, disparage gold. Gold plays no part. They don't understand gold, et cetera. Why does the United States of America have 70% of its reserves in gold, which we do? Well, part of the reason is the fact that we don't need foreign currencies. Why should the United States have a lot of euros or Japanese yen if we can just print dollars, which we can? So historically, the U.S. has not had to keep large amounts of foreign currency in its reserve positions because we print a reserve currency of our own. As a result, gold plays a very large role. And as I say, China only has a little over 1% of its reserves in gold. But that calculation is a little bit misleading for that reason, because the U.S. doesn't have all these other currencies the way China does. I prefer to look at the ratio of gold to GDP. What's the value for gold at the market? What's your GDP? What is that ratio? Because your GDP is your economy, right? That's the total value of all the goods and services your economy produces. So that's what money is for. In theory, money is there to facilitate commerce, and commerce shows up in the GDP figures. Well, if you take the view, as I do, that gold is the real underpinning of the international monetary system, that it never really went away, and it's still the foundation. What is the ratio of gold to GDP? How much real money, i.e. gold, do you have backing up a real economy? Those numbers are fascinating. I've calculated them. They're all in my book. When you say what is money, if you say that to a Fed economist, they say, well, what's your definition of money? Because they have, M3, M2, M1, M0. These are all different definitions of money. They're all quite different, by the way, which is a little fishy in itself. Why isn't money money? Money is whatever the Fed says it is, because they've got 4 different definitions. I call gold M sub-zero. It's the real money behind M0. M0 are basically bank reserves and currency. M sub zero, as I call it, is gold, and that's the real money. It's in the system. But all these calculations are in the book. I think it'd be fascinating for readers to look at the ratios, see who the real gold powers actually are, see who the up-and-comers are. And when you look at those numbers, and I go through this in Chapter 11, you'll see why China is doing what it's doing.
Well, thank you, Jim. It's a conversation that has to continue. It's very difficult sometimes to draw it to an end because each topic opens a new window of questions, and I have more questions that I haven't even been able to ask you today, and we'll do that another day. And I know that we're going to have more questions from our listeners. In fact, we were discussing earlier that we'd love to do more of our interview based on questions that you, the listeners, share with us. So let me make a special appeal today to follow Jim on Twitter. His handle is James G. Rickards, and share your questions. It's very easy. You just type the hashtag #AskJimRickards, and anywhere on Twitter you can do that, and we will find those questions and we will include them in our next interview. But in the meantime, thanks, Jim. It's been great having you with us here today. So just a reminder, you can find Jim's new book, The Death of Money, at Amazon or at any good bookstore, and get yourself a copy if you haven't done so already. It's a really compelling read. So goodbye, Jim, for now.
Thank you, John.
And goodbye to our listeners. Thank you for joining us. Bye-bye.